As John mentioned, we're going to focus on the revenue generation side of the Affordable Care Act. As you can see on the slide, nice bar graph we put together. More than $400 billion in new taxes and fees are expected to be collected between now and 2019 to help pay for the health care legislation. Specifically, I'm going to focus on the first two, the Medicare unearned income tax and the Medicare Payroll Tax. As you can see, that comprises over half of the expected revenues that are part of the Affordable Care Act. I'm going to talk about what those taxes are, who's primarily going to be affected, as well as discuss a couple ideas and thoughts about how we might be able to avoid or mitigate some of those tax liabilities. First off, what is the 3.8% net investment income tax, unearned income tax, Medicare surtax? It's called a couple different things. But basically what it is, it's a 3.8% tax on investment income, okay, of individuals, trusts, and estates to the extent they have income over certain statutory threshold amounts. This is a surtax. It's in addition to regular tax and AMT liabilities. So you compute your regular tax liabilities you normally would, and then do the separate calculation based on your net investment income to determine whether or not you owe the 3.8%. It also is subject to estimated tax provisions, and this is effective for 2013. So if you, or I know we have some CPAs in the audience as well, or your clients are affected by this new tax, you really should be looking at your withholdings or your estimated taxes to see if some adjustments should be made so you have adequate amount paid in to avoid any penalties. I just did actually a tax projection for one of our clients, and we took their 2012 tax situation, literally just sort of flopped it into 2013 initially, did our projection, and this tax alone was a $25,000 increase for that particular client. Bear in mind, it's a high income earner and also had a high portfolio as well that generated a lot of investment income. But for them, $25,000 is a big item, and we need to do our best, obviously, to see if we can mitigate that. Moving along, how's it calculated? It's 3.8% of the lesser of net investment income, or the excess of MAGI, it's called, but basically it's adjusted gross income over a threshold amount. The Congress has established thresholds based on filing status. As you can see, based on those values, this 3.8%, and we're going to talk about the Medicare payroll tax as well. Both taxes are really geared toward, I wouldn't say necessarily wealthy individuals, but definitely upper middle income class families. So married filing joint, $250,000 is the threshold, single $200,000, so on and so forth. I'm going to go through a quick illustration to kind of highlight the main fact that in order to be subject to the 3.8% tax, you really need to have net investment income and your AGI has to exceed the threshold amounts. If either one, if your net investment income is zero or you don't exceed the threshold amount, you're not going to owe this tax. Example one here, during year one, Brendan has AGI of $190,000. He's unmarried, so he's single. He also has $50,000 in net investment income. Because his AGI does not exceed that statutory threshold amount of $200,000, he will not owe the 3.8% tax even though he has $50,000 in net investment income. Okay? In year two, let's assume that his AGI is $220,000. He has the same $50,000 in net investment income. In that example, because his AGI goes over the threshold of $200,000 for a single taxpayer, he now is going to have the 3.8% tax, and it will be the lesser of the amount at which that AGI exceeds the threshold, in this case $20,000, or $50,000 his net investment income. So 20,000 times 3.8%, 760 bucks. So that's basically how the math works with respect to 3.8%. What's included in net investment income? Interest, dividends, normal portfolio income, royalties, rents. There is exception to that. Rents by default under the code is considered to be passive income and would be net investment income for purposes of this tax. But a lot of times we'll have clients that are actively involved in real estate activities, residential real estate, residential rental real estate, commercial real estate, and if their activities rise to the level of being considered a material participating real estate professional under the code, that income, otherwise passive, could be converted to be non-passive and not part of this tax. Passive activity income is an interesting one. This one, it really relates to owners that have ownership interests in passive entities, investment partnerships, or if they have an individual that's silent, not active in a business entity, an SCorp or LLC. That income that flows through to them would be, if it's treated as passive income under the law, it's going to fall into the 3.8% bucket. Excuse me. Capital gains also is going to be part of what's included as investment income. What's excluded from the investment income bucket in terms of this calculation? Active trader business income. So any closely held businesses, owners in S-corps, partnerships, sole proprietors, folks that are out there working hard to help pay for these taxes, your active trader business income is not going to be part of the net investment income tax base. What's interesting is the regs, the proposed regs under Section 1411 actually talks about working capital. So if you've got a business and it's very successful and you've got excess working capital dollars that are being invested in marketable securities or just put aside in a money market account and is generating portfolio income, the regs hold that working capital investment income actually is considered to be passive income, even though you're involved in active trade or business. So that income would flow through to the partners and be treated part of the tax base, which I thought was quite interesting. But again, they're proposed regs, and these things continue to evolve, so we'll see what happens when the regs are finalized. Distributions from qualified plans or IRAs are not investment income. Any self-employment income would be excluded. And to the extent you've got an interest in a working interest in oil or gas property, that also would be excluded from that bucket. And it's important to note that any income that's otherwise excluded under the tax code is also going to be excluded from this net investment income tax calculation. Some ideas or thoughts potentially to mitigate or maybe even avoid the 3.8%. All these ideas, quite frankly, they sound great, but you really got to sit down and look at your relative situation, look at your investment portfolio, what makes sense in terms of where you should be allocating dollars, and it doesn't make sense for you financially. Do you have the cash flow to do some of these things? But tax-exempt bonds, clearly muni bonds, it's tax-exempt income, so obviously it's not subject to regular tax, and it also reduces your AGI threshold. As we looked at that calculation, not only reducing the net investment income bucket is important, but also reducing your AGI on an annual basis to the extent you're near that threshold amount can help reduce this tax. Looking at installment sales, again, taking that any sale proceeds and the relative gain related to a sale of property or even a business interest and spreading that over a period of time not only allows you to defer the income tax consequences related to that, but also will allow you to control and manage your AGI limits too as well for the 3.8% tax. Look to make Roth IRA conversions. I historically have not been a big fan, not usually been a big fan of Roth IRA conversions, but in this situation, again, because the distribution from qualified plans or IRAs are excluded from the definition of investment income, you make that Roth IRA conversion, you got the ability to obviously grow the investment on a tax-deferred basis, tax-free basis over time, accumulates, and then when you take that money out, obviously it's going to be tax-free income and not part of the AGI calculation the year you take that money out. Roth IRA conversions, we'll look at those in the context of maybe we've got a business owner that has a business loss coming from an investment, or even some older folks that are lower taxable income brackets. If we can convert that Roth IRA and not create a huge income tax event in the year of conversion, we definitely look at it. Purchasing life insurance. If you're a business owner, have partners, if you don't currently have life insurance in place to help fund buy-sell arrangements, or quite frankly, if you just don't have life insurance in place for your family, it's something that makes good sense to do from a business perspective and from a personal perspective. But when you're looking at those products, it's just important to note for purpose of this presentation, any inside buildup, any variable whole life policies would be tax-free, not included in the base, and as well as any life insurance proceeds, obviously, in the event of death, God forbid. That also would be excluded from regular taxable income and not part of the AGI threshold calc. This one is a real simple one. If you're at that threshold level, you're looking to adjust your AGI to get beneath it. Fully funding 401k and retirement plans. Whether you're an individual working for somebody and you haven't maxed out your 401k contributions, or if you're a business owner and you don't have a retirement plan set up, or you have it set up and you haven't fully funded it. In this tax rate environment, it makes good sense to put money away on a tax-deferred basis, let it grow tax-free, but it's also going to reduce your AGI in the year of contribution, the year of the deferral. So again, depending on your specific situation and where you're at from an AGI standpoint, you're also going to get the benefit of 3.8% as well. The example pretty much just illustrates some of the things we talked about. Moving forward to the Medicare Payroll Tax. Prior to 2013, all compensation, wages, and self-employment income is subject to the 2.9% Medicare tax, and there's no dollar limit in terms of how much that income is subject to it. Beginning in 2013, that 2.9% rises up to 3.8%. Okay, and in addition to that, and as we'll talk, it's based on threshold amounts as well, very similar to the net investment income tax calculation. But unlike the 3.8% tax, employers are actually involved in this 0.9% Medicare payroll tax. And this, again, applies for this year. So if you've got employees that are earning wages or compensation in excess of $200,000 this year, you're required to withhold another 0.9% on that income. And that obligation exists regardless of whether or not that individual actually owes that tax when they file their return. As we'll talk about when we look at the thresholds, You could have a married filing joint couple that have AGI under $250,000, but say the husband works and the spouse and the wife does not, or vice versa. If that individual makes $230,000, employers is required to withhold the 0.9%. When they go to file their return, they won't actually owe it because they're under the filing threshold. So that tax that got withheld will be obviously creditable against any other tax liabilities that that individual has, or it'll get refunded. So real quickly, here's the same graph we had before. You know, again, you can see the target group in terms of where these taxes are going to come from. They're going to be folks that are making a little bit more money than your average middle-class person. But by all means not, you know, extremely wealthy individuals. Last comment I want to make with respect to this Medicare payroll tax in terms of the self-employment income piece is, you know, we have a lot of clients that are closely held businesses that have multiple business interests. Some are profitable, some aren't profitable. And when you're calculating this 0.9% Medicare payroll tax, you're going to aggregate all that employment, that self-employment activity. In addition, you know, sometimes we have clients that have suspended losses, you know, due to basis limitations otherwise, sitting in some entities. You know, does it make sense to potentially to trigger up some of those losses again to help mitigate some of this tax going forward? Quick example, Jay, partner in a partnership, also has a separate business, he's a sole proprietor, has $300,000 of income from the partnership and a $50,000 loss from his sole proprietorship activity. You know, as I just mentioned, net the two. If he's filing joint, he's at $250,000. He wouldn't owe the 0.9% tax, whereas if he didn't have that $50,000 loss, he would owe it on $50,000 of his self-employment income. Last slide for me, and I'll hand it back to John, deals with just entity selection. Given this 0.9% tax, we're often asked the question, you know, what entity should we be? What should we choose? Should we be an S corporation? Should we be a limited liability company? And it really depends, as always, on the facts and circumstances. You know, are there multiple partners? Do we need to have flexibility in terms of how we share profit and losses and how we take money out of the business? If the answer is no, and I've got a 100% shareholder that's really not looking to bring on any partners anytime soon, you know, S corporation usually is the route we go. In an S corp environment, that amount of income that an owner earns above and beyond the wages they take from that business, it's not self-employment income under current law. So whatever that number is, and the bigger the better, it escapes the 2.9% prior to this year, now 3.8%. So, you know, depending on facts and circumstances, I think that, you know, the argument for S corporation is a little bit stronger today. Last item, bullet point there, though, is there has been activity. There's been proposed legislation in the past, and there's activity now talking about subjecting that K-1 income for S corp shareholders to the self-employment tax. In the past, it's really been in the context of personal service S corporations, but, you know, the way things are trending, I wouldn't be surprised if they close that loop as well. So if you or your clients, I know we have some CPAs in the office, if you or your clients are in the $200,000, $250,000 range, these specific taxes under the Affordable Care Act are going to impact you in 2013. I would encourage you to talk to your advisors and make sure that they're taking your situation and running some analysis and determining whether or not there's things you can do to potentially mitigate or avoid some of the impact. And I'll give this back to John.